I wrote an entire book called Principles for Navigating Big Debt Crises. In it, I analyzed 48 major debt crises going back 100 years. I studied them systematically, the causes, the patterns, the outcomes, the policy responses. And what I discovered is that debt crises are not random events. They're not unpredictable. They follow a template. The same sequence plays out over and over again throughout history. Different countries, different time periods, but the same basic mechanics. And right now, as I look at the global economy in 2025, I see that template playing out again. We're in the late stages of a long-term debt cycle that began after World War II. And if history is any guide, and it always is, we're approaching a major inflection point. A big debt crisis. Not might be, not could be. We are heading toward a big debt crisis in the 2025 to 2030 timeframe. Now, I want to be very clear about what I mean by this. I'm not predicting a stock market crash on a specific date. I'm not saying the world will end. I'm saying that the debt levels we've accumulated, governments, corporations, households, they're unsustainable. And when debt becomes unsustainable, there are only three ways it resolves: austerity, default, or inflation. And in modern economies, the path chosen is almost always inflation. Print money, devalue the currency, inflate away the debt. That's what's coming. In this video, I want to walk you through exactly what I see happening. The mechanics of how we got here. The warning signs that are flashing red right now. The timeline for how this will likely unfold over the next 5 to 10 years. And most importantly, what you need to do to protect yourself and potentially profit. This isn't fear-mongering. This is pattern recognition based on 50 years of studying markets and economic history. The debt supercycle is ending. A new cycle is beginning, and the transition will be turbulent. Let's start with how we got here. To understand where we're going, you need to understand where we've been. And to do that, we need to talk about what I call the long-term debt cycle. Most people understand short-term economic cycles, recessions and expansions that happen every 5 to 10 years. But there's a longer cycle that spans 50 to 75 years. And we're at the end of one right now. The cycle begins after a major reset. The current long-term debt cycle began in 1945 after World War II. The previous debt cycle had ended catastrophically with the Great Depression and a World War. Debt levels have been reset through defaults, restructuring, and a new monetary system, Bretton Woods. In 1945, government debt-to-GDP ratios were high because of the war, but private debt was low. The banking system had been cleaned out. People were cautious about borrowing. Phase 1, the early expansion, 1945 to 1980. For the first few decades, debt grew, but it grew at a reasonable pace. Economic growth was strong. Productivity was increasing. Debt was being used to finance productive investments, factories, infrastructure, education. Interest rates were relatively low. Inflation was manageable, except for the 1970s, which I'll get to. The ratio of debt to income stayed roughly stable because income was growing as fast as debt. This is the healthy phase of the debt cycle. Phase 2, the financialization, 1980 to 2008. Then something changed around 1980. Interest rates peaked at 15 to 20% as central banks fought inflation. And then they began a 40-year decline that only ended in 2021. As rates fell, borrowing became cheaper and easier. Debt began growing faster than income. But this was masked by the fact that lower interest rates meant debt service. Interest payments stayed affordable even as debt levels rose. We entered what I call the financialization phase. Instead of debt financing productive investments, increasingly it financed consumption and asset purchases. People borrowed to buy houses, cars, vacations. Corporations borrowed to buy back stock. Governments borrowed to fund deficits without raising taxes. And because asset prices were rising, stocks, real estate, bonds, everyone felt wealthy. The wealth effect made people willing to borrow more. This phase culminated in 2008 with the global financial crisis. Private debt, especially mortgage debt, had reached unsustainable levels. The system seized up. Credit markets froze. We came very close to a complete collapse. Phase 3, the central bank intervention, 2008 to 2020. Governments and central banks responded with unprecedented intervention. Interest rates went to zero, in some cases negative. Central banks printed trillions of dollars through quantitative easing. The explicit goal was to prevent deflation and keep asset prices elevated. And it worked, if you define success as preventing an immediate collapse. Stock markets recovered. Real estate recovered. Wealthy asset owners got wealthier. But the underlying problem, too much debt, wasn't solved. It was papered over with more debt. Government debt exploded as they ran massive deficits to stimulate the economy. Corporate debt reached record levels as companies borrowed at near-zero rates. Phase 4, the pandemic response, 2020 to 2021. Then COVID hit, and the response was more of the same, but on an even larger scale. Governments around the world printed money and sent it directly to people and businesses. The U.S. alone spent $5 trillion. The Federal Reserve's balance sheet went from $4 trillion to $9 trillion in 18 months. This unprecedented money creation finally triggered what central banks have been trying to create for a decade: inflation. But they got more than they bargained for. Inflation spiked to 9%, levels not seen since the 1980s. Phase 5, where we are now, 2022 to 2025. Central banks were forced to raise interest rates rapidly to fight inflation, from near zero to 5% in less than 2 years. The fastest rate hiking cycle in 40 years. And this is where the debt trap closes. Because now we have record levels of debt, government, corporate, household, much higher interest rates, slowing economic growth. The debt that was accumulated at near zero rates now has to be serviced at 5% rates. And the math doesn't work. Let me give you some numbers to show you how unsustainable this is. U.S. government debt. Total, $36 trillion as of 2025. Debt to GDP ratio, 120%. Annual interest payments, over $1 trillion, more than defense spending. Annual deficit, $2 trillion. Global debt. Total, over $300 trillion. Global debt to GDP, 350%. Much of it borrowed at low rates, now rolling over at higher rates. These numbers are not sustainable, and we're about to hit the point where they break. Before I tell you what I think is coming, you need to understand that not all debt crises are the same. Based on my study of 48 historical crises, I've identified 3 distinct types. And understanding which type we're heading into is critical for positioning yourself correctly. Type 1, deflationary depression. This is what happened in the 1930s. It's what almost happened in 2008. In a deflationary depression, there's too much debt, and it starts defaulting. Banks fail. Credit contracts. People and businesses can't borrow. Spending collapses. Asset prices fall. Unemployment spikes. It's a self-reinforcing downward spiral. Falling prices make debt more expensive in real terms, forcing more defaults, causing more deflation. Key characteristics: widespread defaults, banking system failures, collapsing asset prices, stocks, real estate, rising unemployment, falling prices, deflation. Policy response: central banks cut rates to zero. Government spending increases massively. Bailouts of banks and key industries. Investment strategy: cash and government bonds do well. Stocks and real estate get crushed. Gold is mixed, did well in 1930s eventually. Type 2, inflationary depression. This is what happened in Weimar Germany in the 1920s, Argentina multiple times, Zimbabwe, Venezuela. In an inflationary depression, there's too much debt, and the government responds by printing money to pay it off or to stimulate the economy. This creates inflation, sometimes hyperinflation. The currency loses value. Prices skyrocket. People's savings are destroyed. But interestingly, unemployment might not spike as much as in a deflationary depression because nominal economic activity is high, even if real activity is contracting. Key characteristics: currency debasement, rapidly rising prices, high inflation or hyperinflation. Government debt monetization. Central bank buys government debt. Negative real interest rates. Capital flight to hard assets. Policy response. Central banks print money. Government runs large deficits financed by printing. Eventually, currency reform or dollarization. Investment strategy. Cash is destroyed. Fixed income investments, bonds, are destroyed. Hard assets do well, gold, real estate, commodities. Stocks do well nominally but mixed in real terms. Type 3. Beautiful deleveraging. This is the rare best-case scenario where the debt problem is resolved without either a deflationary crash or an inflationary spiral. It requires a careful balance of four things: austerity, cutting spending; debt restructuring/defaults, enough to reduce the burden; wealth redistribution, higher taxes on wealthy; money printing, just enough to offset deflation. If these four are balanced correctly, you get a gradual reduction in debt-to-income ratios without a crisis. Painful, but manageable. Historical examples. U.S. after World War II, 1945 to 1980. Parts of Europe in the 1990s. Key characteristics: gradual deleveraging, moderate growth, controlled inflation, manageable unemployment. Investment strategy: balanced portfolio works, modest returns across asset classes. Stability more than spectacular gains. Now, here's the critical question. Which type of crisis is coming in 2025 to 2030? Based on the current setup, massive government debt, political constraints on austerity, central banks that have shown willingness to print money, and global reserve currency dynamics, I believe we're heading toward Type 2, an inflationary debt crisis. Not hyperinflation like Weimar or Zimbabwe, but significant, persistent inflation, probably 4 to 7% annually, as governments choose to inflate away their debts rather than default or implement austerity. Let me explain why. Governments facing unsustainable debt have three options: austerity, default, or inflation. Let me explain why, in modern democracies, inflation is almost always the path chosen. Why not austerity? Austerity means cutting government spending or raising taxes to reduce deficits and pay down debt. Theoretically sound, practically impossible. Why? Politics. Imagine you're a politician in the US, Europe, or Japan. Your country has massive debt. You propose cutting Social Security, Medicare, defense spending, and raising taxes significantly. What happens? You lose the next election. Voters punish fiscal responsibility. They want benefits now and are willing to push costs to the future. Every attempt at austerity in democracies has failed politically. Greece tried it in 2010 to 2015. There were riots in the streets. The UK tried it in 2010. They abandoned it within a few years. It doesn't work politically. So austerity is off the table in most developed democracies. Why not outright default? Default means the government says, we can't pay our debts. Bondholders get 50 cents on the dollar or nothing. This sounds absurd for countries like the US, Japan, or European nations. But it's happened before. Russia in 1998, Argentina multiple times, Greece in 2012, a structured default. Why don't developed countries do this? Several reasons. First, credibility destruction. If the US defaulted on its debt, the dollar's status as global reserve currency would be finished. The entire global financial system, which is built on the assumption that US treasuries are risk-free, would collapse. The damage would be catastrophic. Second, legal and political chaos. Much of government debt is owned domestically by pension funds, insurance companies, ordinary savers. Defaulting would destroy the retirement savings of millions of voters. Political suicide. Third, alternatives exist. Unlike a corporation or household, a government that issues its own currency has another option: print money. So outright default is also unlikely for major developed economies. Why inflation is the chosen path? That leaves inflation. And inflation has several advantages from a government's perspective. Advantage 1. Political feasibility. Inflation is a hidden tax. Most people don't understand it. They see prices rising and blame corporations, supply chains, greed, anything except the actual cause, money printing. Politicians can print money, blame inflation on external factors, and avoid direct accountability. It's politically easier than cutting, spending, or raising taxes explicitly. Advantage 2. Debt reduction in real terms. If you owe $100 and inflation is 5% per year, after 10 years, that $100 debt is worth only $61 in real purchasing power. You've effectively defaulted on 39% of the debt without officially defaulting. Governments with massive debts benefit enormously from inflation. It erodes the real value of their obligations. Advantage 3. Maintains the system. Unlike default, which would crash the financial system, inflation allows the system to continue functioning. Banks stay solvent. Bond markets keep operating. The wheels keep turning, even as the currency slowly debases. The historical precedent. Every time a major power has faced unsustainable debt loads, they've chosen inflation. Rome debased their currency, reduced silver content in coins to pay debts. UK after World War I and World War II inflated away war debts over decades. US in the 1970s inflated away debts accumulated in 1960s. All hyperinflations, Weimar, Zimbabwe, Venezuela, governments printing money to pay debts. The pattern is clear. When you control the printing press, you use it. The current setup. Right now we have government debt that can't be paid back without massive economic pain. Political systems that can't implement austerity. Central banks that have demonstrated willingness to print money, 2008 to 2021. Precedent from COVID. When crisis hits, print money and send it directly to people. The path is set. The next crisis, which I believe will hit between 2025 and 2030, will be met with more money printing. And that will create sustained inflation. Not 9% like 2022. That was a shock. But persistent 4 to 7% inflation that lasts for years, slowly eroding debt burdens and destroying savings. This is what's coming. Let me walk you through how I think this will unfold over the next 5 to 10 years. This is based on historical patterns, current conditions, and the mechanics of debt cycles. Phase 1. The triggering event, 2025 to 2027. Something will trigger the crisis. I don't know exactly what, but likely candidates include Possibility 1, a recession. The U.S. or global economy enters recession. Tax revenues fall, deficits explode, debt levels spike. Investors start questioning whether governments can service their debts. Possibility 2, a sovereign debt crisis. A major country, maybe Italy, Japan, or even a U.S. state like California or Illinois, faces a debt crisis. They can't roll over maturing debt at reasonable rates. This spreads contagion fears. Possibility 3, a banking crisis. We saw a preview in March 2023 with Silicon Valley Bank and regional bank failures. Another wave of bank failures, possibly triggered by commercial real estate defaults, could spark a broader crisis. Possibility 4, a geopolitical shock. War, pandemic, climate disaster. Something that forces massive government spending at a time when finances are already strained. Whatever the trigger, it will create a moment of panic. Stock markets will fall 20 to 30%. Credit spreads will blow out. Governments will face a choice. Allow a deflationary collapse or print money. They'll choose to print money. Phase 2, the policy response, 2027 to 2028. Central banks will cut rates back to zero or negative. They'll resume quantitative easing, QE, on a massive scale. But this time, it won't just be buying bonds. It will be more direct. I expect we'll see helicopter money, direct payments to citizens like COVID stimulus but ongoing. Universal basic income in some form. Yield curve control. Central banks explicitly capping interest rates on government bonds at low levels, like Japan has done. Debt monetization. Central banks directly financing government deficits by creating money to buy government bonds. The messaging will be about supporting the economy, protecting jobs, ensuring stability. But the effect will be massive money creation. In the U.S., I expect the Federal Reserve's balance sheet, which is currently around $7 to $8 trillion, to expand to $15 to $20 trillion. The money supply will increase by 50 to 100% over 2 to 3 years. Phase 3, the inflationary surge, 2028 to 2030. All that money creation will reignite inflation. But this time, it won't be transitory. It will be structural. I expect inflation to settle in the 4 to 7% range for an extended period, maybe a decade. Not hyperinflation, but significantly above the 2% target central banks pretend to care about. Why not hyperinflation? Because the dollar is the global reserve currency, though this status will weaken. There are offsetting deflationary forces, aging demographics, technology, debt overhang. Central banks will try to manage it, though they'll fail to keep it at 2%. But 5% inflation sustained over a decade has enormous effects. Purchasing power of the dollar cut in half. Real wages decline, nominal wages won't keep up, savers are destroyed, bank deposits lose value. Debtors benefit, debt burden falls in real terms. Asset prices rise nominally, stocks, real estate, gold. Phase 4, currency regime change, 2030 to 2035. Eventually, probably in the early to mid-2030s, the dollar's dominance as global reserve currency will be challenged. This won't happen overnight, but gradually other countries will. Diversify reserves away from dollars. Create alternative payment systems, China's CIPS, BRICS currency initiatives. Settle trade in other currencies or basket of currencies. The US will still be important, but it will be one of several major currencies rather than the dominant one. This shift will reduce global demand for dollars, putting additional downward pressure on the currency's value. We might see a new Bretton Woods-style conference where major powers agree on a new monetary system, possibly with some link to gold or a basket of commodities, though I'm not certain about the exact form. Phase 5, the new equilibrium, 2035 plus. Eventually, we'll reach a new equilibrium. Debt to GDP ratios will have come down through inflation, not through payback, but through debasement. A new monetary system will be in place. Growth will resume at a moderate pace, but the world will look different. Wealth will have been redistributed from savers to debtors, from fixed income to hard assets. The middle class will be poorer in real terms. Inequality will likely be worse. Trust in institutions will be lower. And the cycle will begin again. Because humans never learn. The key dates to watch: 2025 to 2026. Watch for the triggering event. Recession, banking crisis, debt crisis. 2027 to 2028. Watch for the policy response. More QE, negative rates, helicopter money. 2028 to 2030. Watch for persistent inflation returning. 4 to 7% becoming the new normal. 2030 to 2035. Watch for dollar regime change. New monetary system emerging. This is the roadmap. It won't play out exactly as I've described. Nothing ever does. But the broad pattern will follow this template because it always has. 2030 to 2400 hours 30. How to position yourself. All right. So if this is what's coming, an inflationary debt crisis unfolding over 2025 to 2030, how do you position yourself to not just survive, but thrive? Let me break down the strategic positioning across different phases. Phase 1, before the crisis, now through 2026 to 2027. Right now, we're in the calm before the storm. Asset prices are still relatively high. Credit is still flowing. The system is still functioning. What to do? Action 1. Reduce exposure to long-term fixed income investments. Long-term bonds will get destroyed in an inflationary scenario. If you hold 30-year Treasury bonds and we get 5 to 7% sustained inflation, you'll lose 50 to 70% of your purchasing power. Avoid long-term bonds. If you need bond exposure for stability, use short-term bonds, 1 to 3 years, or floating rate bonds that adjust with interest rates. Action 2. Increase allocation to inflation-protected bonds, TIPS. I've talked about this before. TIPS automatically adjust for inflation. In an inflationary debt crisis, they're one of the few fixed income instruments that protect you. Target 15 to 25% of portfolio in tips. Action 3. Build gold position to 10 to 15% of portfolio. Gold is the classic inflation hedge. In the 1970s inflation, gold went from $35 per oz to $850 per oz. In an inflationary debt crisis, gold will likely perform very well. Don't wait until gold is $3,000 per oz. Build your position now at $2,000 to $2,500 per oz. Action 4. Own real assets, commodities, real estate. Real assets tend to hold value during inflation. Commodities, energy, metals, agriculture often surge. Real estate, especially with fixed-rate debt, is a good inflation hedge. Target 10 to 15% in commodity exposure, plus your primary residence with a long-term fixed-rate mortgage. Action 5. Maintain quality equity exposure. Stocks are not a perfect inflation hedge, but they're better than cash or bonds. Companies can raise prices to offset inflation, at least partially. Focus on companies with pricing power, strong brands, monopolies. International diversification. Emerging markets may outperform. Value stocks over growth. Lower valuations provide more margin of safety. Target 30 to 40% in globally diversified equities. Action 6. Build cash reserves for the initial panic. When the crisis hits, there will be a period of panic. Asset prices will fall sharply before the money printing begins. Having cash lets you buy at those panic prices. Target 10 to 20% in cash or money market funds. Phase 2. During the initial crisis, 2027 to 2028. When the triggering event happens and markets crash, this is your opportunity. What to do? Deploy cash strategically. As stocks fall 20 to 30%, start buying quality companies at discounts. Dollar cost average over several months. Don't try to time the exact bottom. Increase tips exposure. As crisis hits and inflation fears return, tips spreads might widen temporarily. This is a buying opportunity. Avoid panic selling. The worst thing you can do is sell your stocks, gold, and real assets in a panic and move to cash. That's exactly backward. You want to move from cash to real assets during this phase. Phase 3. During the inflationary surge, 2028 to 2030. As central banks print money and inflation accelerates, your real asset positions will start to pay off. What to do? Hold your gold, commodities, and tips. These will be performing well. Resist the temptation to sell. The inflation will likely persist longer than people expect. Consider adding Bitcoin/crypto. Controversial. I'm not a Bitcoin maximalist, but in an inflationary environment where people lose faith in fiat currencies, Bitcoin might serve as an alternative store of value. I'd keep this to 2 to 5% of portfolio maximum. Own productive land or real estate with fixed-rate debt. If you have a 30-year mortgage at 3% and inflation is 6%, you're effectively getting paid to own that asset. The real value of your debt is shrinking while the nominal value of the property rises. Rebalance regularly. As asset classes surge or fall, rebalance back to your targets. This forces you to sell high and buy low systematically. Phase 4. After the currency regime shift 2030s. Eventually, we'll reach a new equilibrium. Inflation will moderate. A new monetary system will emerge. What to do? Reassess portfolio for the new regime. Whatever the new system looks like, adjust accordingly. If there's a gold-backed currency or commodity-backed system, gold might become less volatile but maintain value. If it's a multipolar currency world, diversification across currencies becomes important. Focus on quality businesses and real assets. Regardless of the monetary system, companies that produce real value and real assets will maintain purchasing power. The overall strategic allocation for 2025 to 2030. Here's how I'd structure a portfolio for the coming debt crisis. 30% global equities. Focus on value, pricing power, international diversification. 25% inflation-protected bonds, TIPS, core inflation protection. 15% gold, crisis hedge and inflation protection. 10% commodities, energy, metals, agriculture. 10% real estate or land, preferably with fixed-rate financing. 10% cash for opportunities during initial panic. Total 100%. This is not the portfolio to maximize returns in a roaring bull market. This is the portfolio to survive and thrive through an inflationary debt crisis. Let me close with some final thoughts and action steps. What I'm most confident about. We will have a major debt crisis in the next 5 to 10 years. The math doesn't work. The debt can't be serviced without either default or debasement. The response will be money printing. Governments will choose inflation over austerity or default. Inflation will be higher and more persistent than most people expect. Not hyperinflation, but 4 to 7% sustained inflation over years. The dollar's reserve status will decline. Not disappear, but weaken significantly. Real assets will outperform financial assets. Gold, commodities, real estate will preserve purchasing power better than stocks and bonds. What I'm less certain about, the exact timing. Could start in 2025, could be 2028. I can't predict the exact triggering event. The severity. Will it be managed 4 to 5% inflation or chaotic 7 to 10% inflation? I don't know. The political response. There could be policy shifts I'm not anticipating. International dynamics. How China, Europe, emerging markets react will affect the outcome. Action steps for the next 30 days. Week 1. Assessment. Review your current portfolio. Calculate exposure to long-term bonds. Reduce if high. Evaluate your inflation protection, tips, gold, commodities. Week 2. Education. Read my book, Principles for Navigating Big Debt Crises. Study the 1970s inflation period. Understand historical debt crisis patterns. Week 3. Rebalancing. Begin shifting out of long-term bonds. Start building gold position. Aim for 10 to 15%. Add tips exposure. Aim for 15 to 25%. Week 4. Planning. Create a written investment plan for the crisis. Share with family or advisor. Set rebalancing schedule, quarterly or annually. The most important thing, don't panic. Don't become paralyzed by fear. But also don't be complacent. The debt crisis is coming. The exact timing is uncertain, but the direction is clear. Those who prepare will survive and potentially thrive. Those who don't will see their wealth evaporated by inflation and poor policy. I've navigated 8 major market crises in my 50-year career. The 1970s inflation, the 1987 crash, the 2000 dot-com bubble, the 2008 financial crisis. They all follow patterns. They were all survivable if you understood the mechanics and positioned correctly. This coming crisis will be no different. Understand the pattern. Position accordingly. Execute with discipline. Subscribe to this channel for ongoing analysis as this unfolds. And remember, in a crisis, preparation is everything. Thank you for watching. Stay vigilant. Stay prepared.